Thank you for joining our Financial Lens episode titled Strategies for Dislocated Financial Markets. What do we mean by dislocated financial markets? Well, it's those market cycles, the times in the economy when investments, the value of investments, and their expected returns deviate significantly from historic averages and benchmarks. Historically, the stock market gets around 10%, the bond market gets about 5%, and cash gets about 3%. When we look at cash, we know banks pay virtually nothing, so that is a much lower return than the 3% historic average. Well, the same thing is true of bonds. Now, these are estimates by Vanguard. So this analysis that I'm giving you is based on their data and the opinion that I have based on their data, assuming that their projections are correct. It is estimated by Vanguard that the bond market over the next 10 years will earn someplace around 1.5% to 2.5%, which is about a third of the historic 5% average that it would get. So when we look at the bond market, we don't expect to get nearly what the bonds have gotten in times past. The stock market has a similar story. The stock market typically gets about 10%. Vanguard estimates that the returns of U.S. stocks, U.S. equities, will be between 2.5% and 4.5%, about a third of their historic average. And international equities will get someplace between 5% and 7%, about half of their historic average. So the question is, how did we get to this place? Well, let's look back in time. Back in 2018, Vanguard had made projections that the equities in the United States would not get the 10% that they had historically received, but that they would get closer to maybe 6.5% average over the next 10 years. So over a 2-year period, if we got a 6.5% average, we would anticipate that we might get 13%. Well, what actually happened is that the stock market grew by almost 30%. About 2.5 times the anticipated returns. Well, how did that happen? Why did that happen? Because of economic policies prior to the election and anticipations by the consumers that this is a good time to be in a market, evaluated, or I should say valued, the stock market at a more favorable valuation than might have been based on previous data. Meaning that the stock market grew a lot, and that growth might very well have been received by pulling future growth from the market. So what Vanguard did is they reduced their estimate on what the stock market might return over the next 10 years from 6.5% to 5%. If the stock market got 5% return, we would expect over a 2-year period that it would get maybe 10%. But the stock market grew over that 2-year period from the year 2020 to 2022 by closer to 30%. So it grew significantly higher, maybe 3 times the expected return. And why was that? It was based on economic policies not related to economic performance, but consumers' beliefs that the stock market would not go down, that you cannot pay too much for stock because it will not be, the value won't be lost in the stock market, and future returns in the stock market were pulled forward. So based on the expected returns of stocks and bonds, what are opportunities for the investor? Well, one opportunity is to look at equities and allocate to those equities that might get us better returns. U.S. equities are expected to get between 2.25% and 4.25%, while international are expected to get maybe 5 to 7. So with a more international heavy focused portfolio, we might get some better returns. We do have to keep in mind, however, that international equities have more risk. Another strategy that we might want to keep in mind is replacing bonds, which are designed to give us more stability in our portfolio. The bonds don't expect to get as much returns as stock, but they're less risky. We may want to consider replacing them with certain types of annuities. The types of annuities that I would recommend are annuities that do not have investment risk. These are called fixed annuities, and they provide returns without that concern about the market losing money. Also, I do prefer fixed annuities that do not have fees. The last thing we want to talk about is what I refer to as a disposition strategy. A disposition strategy is an understanding that we have assets in place because we want those assets to do something for us. So when we have a portfolio, we want the portfolio to grow, and not simply to have more money, but we want to have the availability to use that money for what we want to spend it on. We may want to have more income to enjoy our retirement more. So we could grow our portfolio so it's worth more so we can spend more, or in this environment when we are thinking we may not get the best returns, we may want to consider taking some money and put that into an income annuity and not have to worry about the performance. This is a particularly interesting strategy for individuals who have a long life expectancy, and it's actually an important potential strategy for folks who don't have too much in the way of assets and are concerned about running out of money. The second disposition we want to look at is the need for long-term care costs being paid. We could build our portfolio and figure if we have a long-term care need, we'll use funds in our portfolio, but we might want to consider long-term care. With a long-term care policy, we can eliminate that risk of long-term care and know that if we have that need, there's an insurance policy in place that we don't have to worry about taking money from our portfolio and then be concerned about what is left in that portfolio for a spouse or for loved ones. Speaking about loved ones, we may want to be leaving money to our heirs. That might be an important objective for you listeners. And we may want to leave a specified amount of money to our heirs. Of course, we can leave whatever's left is left. But if we have a legacy ambition where we want to leave money to our heirs, we may want to consider a life insurance product which will give us a guaranteed death benefit upon our passing, of course, assuming that the insurance company is financially sound. Thank you for joining us for our Financial Lens episode titled Strategies for Dislocated Financial Markets.